Okay, you've definitely seen the headlines. The Federal Reserve is raising rates or cutting rates, and everyone's talking about it. But what does that actually mean for your portfolio? For your 401k? Well, today we're going to break down exactly how the Fed's decisions ripple out and affect your investments.
And this really is the big question, isn't it? The moment you hear the Fed is making a move, that gut reaction can be to freak out a little bit. But here's the short answer. No, you shouldn't panic. And to really understand why, we first have to get to know the main player in this whole story. All right, so let's pull back the curtain on this group that has so much power over the economy, the Federal Reserve, or as you always hear, the Fed. What exactly is this institution and what's its big picture role? The easiest way to think about the Fed is like this. It's America's central bank. It's literally the bank for all the other banks. So just like you have an account at, say, Chase or Bank of America, they have accounts at the Fed. It's pretty much the top of the financial food chain. Now, the Fed has a lot of tools, but its most powerful one is something called the federal funds rate. Yeah, I know it sounds super complicated, but it's actually pretty simple. It's just the target interest rate for banks to lend money to each other overnight. But here's what's so crucial. This one number creates this massive ripple effect that ends up influencing the cost of everything from your mortgage and car loan to huge business investments. So let's talk about that ripple effect. I want you to imagine a giant seesaw. When interest rates go up on one side, it tilts the whole market one way. And when they go down on the other side, everything tilts back in the opposite direction. Let's break down how that seesaw works. When rates go up, borrowing money gets way more expensive for everyone. So companies tend to slow down their spending and growth. But safer investments like government bonds suddenly look a lot more attractive because they're paying you more. And hey, your savings account might actually pay you a little something too. Now, when rates go down, the opposite happens. Borrowing becomes cheap, so companies can get money easily to expand. And in that world, stocks often look like a much better deal than sleepy bonds or savings accounts. Okay, so that's the big picture. Now, let's get personal. Let's connect all of this directly to your portfolio. How do these big, sweeping changes actually translate to the money sitting in your investment accounts? We're going to look at 3 really common types of investments that chances are you probably hold in some way. Your broad S&P 500 index funds, those high-flying growth stocks, and the more steady dividend-paying stocks. Each one of them dances to a slightly different tune when rates change. So first up, S&P 500 index funds. These are your broad market trackers. And oh yeah, they absolutely feel the market's mood swings in the short term. Rate hikes can definitely push them down for a bit. But, and this is the most important part for long-term investors, historically, the S&P 500 has recovered from every single one of these rate cycles and gone on to reach new highs. Think about that for a second. Every single time. Okay, what about growth stocks? Like a lot of the big tech companies. These guys often get hit the hardest when interest rates go up. And the reason why is actually pretty cool. A huge chunk of their value is based on the giant profits they're expected to make way out in the future. Well, when interest rates rise, those future profits are worth less in today's money. It's a simple math problem that can have a huge impact on their stock price right now. And finally, let's talk dividend stocks. Now, these companies face a totally different kind of challenge. When the Fed raises rates, suddenly super safe government bonds start paying out a pretty decent return. So if you're an investor, you have to ask yourself, why would I take the risk of this stock when I can get a similar, much safer return from a bond? Suddenly, these dividend stocks have some serious competition for your money. So, after hearing all that, what do? What is the winning strategy? What's the single most powerful move you as a long-term investor can make when you see all those scary headlines? It honestly comes down to this. It is so simple, but it is so hard. The most important thing to remember is this. Don't panic. I know market volatility feels awful, but making big decisions based on emotion is almost always the wrong move. And it all comes back to one incredibly powerful historical fact. The stock market has recovered from every single rate cycle in its history. The people who really get hurt are the ones who sell in a panic near the bottom. The people who win are the ones who just stay the course. Patience really is your superpower here. So the next time you see a headline about the Fed, you'll know exactly what's going on behind the scenes. The economy is always going to have its ups and downs. That's just a natural cycle. The real question you have to ask yourself is, will your patience